we are going to dive into this amazing webinar that we've got planned for you around the 8 questions that every business owner needs to answer for their exit strategy in particular. So first off, if you're here, feel free to drop in the chat the state that you're from. We work with clients all around the country. We've got partners and clients all around the country, but feel free to drop in a 2-letter state name into the chat. And logical question that we've got today is, why 8 questions, Micah? Well, these are the 8 questions that you need to ask to be successful in your own exit strategy. To get really clear on where you want to go, these are the 8 questions that we work through with every client in the first 6 months of the engagement that we have with them. And so we want to walk you through that process today and help you get clear on exactly where you're at and exactly where you need to go. Really tough to get to the right destination if you don't know where you are today and where you're headed. And so that's a lot of what we're planning on addressing in this webinar today. Hey, up on screen, you can see our agenda. A couple of different things. We'll just key in real quickly on a quick opportunity for you to get clarity even in the first couple of minutes of this webinar by taking a ready to exit assessment that we have available to you. It's totally for free. It's 15 questions and you can figure out your score on that. Just going to speak super quickly, 60 seconds, my own background and relevance on this particular topic. We're going to talk about the 4 different experiences that owners have as they go to exit. We're going to talk about what makes for a legendary exit. But really where we're going to focus our time and the majority of the time today is answering these 8 key questions that every business owner needs to answer to be able to get that clarity about where you are today, where you want to go, and actually how to bridge the gap to get there. One thing I'll call out before we dive in is Q&A. If you're new to Zoom, there is a Q&A feature. You can find it in your controls section. If you've got questions along the way, drop them into the Q&A section. We will definitely come back and answer those at different moments throughout the webinar and the workshop today. But then certainly at the very end, we're going to have a live Q&A time. So if you've got questions along the way, you want to ask them live, get ready, because at the end, we will have an opportunity for that to happen as well. So again, some of those questions you might have might be around the process. They might be around, hey, how do I not pay 20 to 30% of my exit in terms of taxes? Could be anything around that. And so just keep those questions, pop them into the chat, or get those ready for the very end. But with that, I do want to show up on screen a quick QR code. So if you're on desktop, you can pull out your mobile phone, take a snapshot of this, key in and tap on that, and literally in 15 questions or less, you can figure out how ready that you might be to exit, both in your attractiveness and readiness to sell. It's a great first step. Give you some real-time feedback. If you score 72% or higher on this quick assessment, you are likely best in class. Congrats. If you score less than 58% on this assessment, you are likely below average. And I will say, I do see some partners here in this call. Bob, I see you. Bill, I see you. Rick, others that are here. This is a great first step for any client that you work with to gain insights and clarity on how to get traction and really understand how to move forward towards that exit. One last thing I'll share with you before we formally dive in, and that is we are committed to helping entrepreneurs get clarity. Helping entrepreneurs get clarity on exactly what they need to do to go from their current state all the way to the exit. And so our calendars are full, but we are giving away a free strategy session. So stick around with us until the end. We'll have details about how to apply for that. And we're giving away one of those this month. So with that, I'll jump to just a couple of quick opening remarks. And while I share these opening remarks, I would ask you this question and ask you to pop it into the chat. What is the number one question that you have about exiting your business? If you're an advisor to business owners, what's the number one question that they have or that you've been hearing recently about exiting your business? I'd love to have you drop that into the chat. Maybe it's what your business is worth. Maybe it's how to grow the value of the company from where it is today to where you would like it to be. Maybe it's around the process. Maybe it's, hey, I don't understand all of the folks that I need to have on my advisory team. Maybe it's around how to build a best-in-class business. Whatever that is, and whatever that question is, that number one question that you've got, drop it into the chat, and love to address those as we go along, as we have opportunity. And while you're doing that and putting that into the chat, I'll just share with you super briefly my own background and my own story pertaining to exit advisory. First 10 years of my career, I worked in banking, loaned a lot of money to different companies. And that gave me a front seat to really thinking about great businesses and what drove them. About 10 years ago, I left that big corporate world and I came down into the entrepreneurial space. working as a leader inside of companies doing less than 100 million in annual sales. I've been a president, I've been a chief operating officer, I've been a CFO. Some of those experiences led me into high growth companies. You can see on screen, I've ended up on the Inc. Fast 5,000 list 3 different times. The last time was at position 199. We grew a company from 10 to 50 million in about 18 months. So not just familiar with the exiting process, but very familiar with how to scale companies and grow companies in a really sustainable way. And certainly we've helped a lot of clients along the way and over the years grow their own valuation. With that, I do want to talk as we start about the 4 different exit experiences that entrepreneurs have. And so what you'll see up on screen is that sadly, the reality of most folks that go to market to sell their company is that they fail to transact, 70% in fact. And that's a really sad metric because when you think about the fact that 80% of a typical entrepreneur's net worth is locked up inside of the business. Think about yourself. How does that compare for you? What is your business worth? What's your net worth? What is the percentage that your business comprises of your net worth? I'm going to take a stab that it's the majority of your net worth for most of you on this call that are business owners. Um, what you're also going to see is that a minority of business owners, 30%, actually successfully transact, get all the way through to the finish line and are able to move on from their business. It's a really small subset, less than 10% of those successful folks that we find start early enough, take the steps that they need to take in order to be able to maximize price and terms. But here's the thing. The other piece that you're going to realize is that even as you dig into the space of exits, is that even those folks who successfully sell, even those folks who maximize their exit, in all of that focus on talking about the numbers, uh, one of the shocking stats is that 70% of owners who transact, who actually sell that company, 70% within 1 year deeply regret selling their company. And so I think what we learned from that is that exiting is way more than just the numbers. It involves all of us as a human being. It involves our emotions, right? Regret is an emotion. It's not a quantitative thing. And so one of the things that we do in our practice is that we help folks achieve what we believe is the rarest of all exits, what we call a legendary exit. When we talk about legends, that naturally evokes things like the story of Atlantis or the story of Robin Hood. These are tales that we tell of people and places that are so amazing that they continue to persist long after they're gone and long after they occurred. And so what I want to talk to you about today, within the context of these 8 questions, is how do you craft an exit that not only you're happy with and delighted with, but that your kids are talking about and your grandkids are talking about, and that the next generation will talk about long after you are gone. And as a sneak preview, it's way more than the numbers. So, what is a legendary exit? I want to go there next in our conversation. It's what you see on screen. A legendary exit starts by living a life of significance. It's not about the numbers, it's about living a life of meaning and purpose. Getting clear on your personal values, getting clear on your purpose of why you're here on this earth, getting clear about what's unique about you, the gifts you've been given, and the skills you've cultivated. We're going to talk more about this in our 8 questions. As we get clear on that, then we move to having a level of clarity that enables us to leverage our exit to fully fund our personal financial goals. Literally, a custom number that enables you to live the life you want to live and be fully independent financially for the rest of your life. Thirdly, it means transforming your company to be best in class. That's a term that we use to describe companies that are at the 75th percentile. They are better than 75% of all companies in their industry. Why? A whole lot of reasons, but so that they can have a bigger impact on the stakeholders, their employees, their customers, even their own families. Because at the end of the day, business is about people. Life is about people. It's not just about the dollars and the cents, although that's important too. You say, hey, Micah, this is great. I love the idea of living a life of significance, and I love the idea of, getting clear on how to leverage my exit to fully fund my financial goals or building a best-in-class company. But what does this philosophy actually produce? And what you're seeing up on screen is the average results that each one of our clients experienced last year in 2024. Within the first 6 to 12 months of engaging with our clients, we typically increase their profitability by over 30%. The second thing that's true is that we grow their valuations. We develop a 5-year plan, and that those 5-year plans for clients have been to 2x the valuation, 3x, 4x their valuation. Take clients from 3 to 12 million, 10 to 25 million in their valuation. These are real world scenarios that we are marching the ball down the field on. And so if you want to grow your profits, if you want to double, triple, or 4x your valuation over the next 5 years, then you're going to want to lean in. You're going to want to pay attention to these 8 questions because these are not only the questions that you need to answer, but these are the 8 questions that we also work with our clients to answer over the first 6 months that we work with any client at Legendary Exits. And so with that, in no further ado, I want to dive right into the 8 questions. So what are these 8 questions that you need to answer in order to craft your own legendary exit, in order to beat regret, in order to fully fund your personal financial goals, in order to create a best-in-class company? Here we go. Question 1. Am I able to sell? Is my business attractive? And is my business ready? I want to dive into these 2 concepts real briefly. You say, Michael, what is attractiveness? I'm going to take a swing that most folks in this call have bought a home or are familiar with the home buying process. I want you to think about attractiveness as curb appeal. And I want you to think about readiness to sell as able to pass the home inspection. So let's dive into each. Attractiveness means, again, that you are ready to sell. That you are attractive to a potential buyer. That initial sniff test, again, that sort of word picture of pulling up to the front of the house and saying, wow, this is a beautiful home. I'd love to live here. It is the equivalent of that from a buyer's point of view when they look at your company. You say, Micah, what would that look like? Again, the quiz that I gave you that QR code to a minute ago, and we'll have it up at the end, that's a starting point to that, 15 questions. But when we work with a client, we take them through 103 questions across 13 different sections. In attractiveness, there are 28 questions. I'm going to share with you 3 of my favorite ones, right? Question 1, the tenure, experience, and results of our management team would impress a potential purchaser. Question 2, our business is not dependent on our owner to operate. That's a big one. Question 3, our gross margin and EBITDA percentage are best in class for our industry. So there are certain things that when you go to look to buy a company, there are certain things you look at first, just like you might look at bed and bath count and a square footage when you buy a house. There are certain things that a buyer of a company is looking for. Financial performance, a lack of dependency upon the owner to sell and to operate the business, a great management team that can run it. That's attractiveness, right? And so again, that quiz that I put up at the beginning and I'll have at the end is a starting point on this, but certainly we go a lot deeper with our clients. You say, hey, Michael, what is readiness? Give me some examples there. You likened it to a home inspection on a house. So a buyer comes in, agrees to buy your company at a certain price, and there's a period in which they can do due diligence between signing that and actually closing the deal. And so again, we assess companies across 74 questions when we take on a client in 10 different categories. You say, hey, what are some of those questions? 3. I'll give you 3. Our business has an employee handbook that is aligned with our business and reviewed by our outside legal counsel. Huge for employee compliance. Second, it's a financial question. We close our books and produce monthly financial statements by the 15th of the following month, if not sooner, to share with our leadership team. So it speaks to the speed at which we produce financial statements as well as the openness with which we share them with our leadership team. Third question, our team has a defined schedule and a defined process for doing strategic and operational planning, including goal setting, plan development, forecasting, and budgeting. Just 3 questions amongst 74 to give you a taste of some of that operational and financial due diligence that happens. What you want to do when you're doing due diligence, and what you want to do in this area is you want to get in the shoes and in the mind of an acquirer. And those that, are you attractive? Are you ready to pass financial due diligence, legal due diligence, operational due diligence? How can you define now the things that need to change before you list the company for sale, whether that's 3 years from now, 5 years from now, 10 years from now, or even longer than that? In the beauty of defining those things today, the value of due diligence isn't just completing the sale. It's actually identifying now what's going to drive your business to greater performance in the future. So the value of getting really clear on attractiveness and readiness, curb appeal, and passing the home inspection, so to speak, is pinpointing those opportunities from an outside acquirer's point of view that are totally going to transform your business and drive you to greater growth, greater profitability, and greater valuation. A second question out of the 8 that you need to answer if you're going to successfully navigate and even achieve a legendary exit is this question. Is your business best in class? You say, Michael, what's best in class performance? Best in class performance is not average performance, to be clear. It's not above average performance. It's the performance of a market leader in a given industry. A company that is blazing the trail at the 75th percentile and above. You are better than 75% of companies. You say, how would I know that? And I would say you can set a lot of different metrics in business, but the litmus test I always look at is profit percentage. Profit percentage ought to pick up a lot of different things in it. Folks say to me all the time, hey, Michael, we've got an amazing team. We've got great relationships with customers. We've got amazing intellectual property. I say, hey, that's great. If I get to look at one metric that I'm expecting to see all of that reflected in, it's profit as a percentage of your total sales or revenue. If you've got a great team, if you've got great customer relationships, you have an amazing offer and you're doing wonderful work, then you ought to be at the top of the house in terms of profit percentage. And so it's really easy oftentimes to settle for less than best because we don't go out to the market and compare ourselves against other companies. And so what we like to do, and what I encourage every client to do that we work with and business owners I come across, is go to the market and define what best-in-class profit percentage is. Go to the market and define best-in-class profit percentage. You say, hey, what's the value of doing it? First off, how would I do it, and what's the value of doing it? So let's talk about these two things. The value of doing it, or how would I do it rather? There's 4 different ways commonly that companies benchmark performance, and you see them up on screen. Way 1, you use a third-party data vendor. These are a great reason to leverage external consultants like our team at Legendary Exits. But there are certainly third-party options out there like Profit Sense, like PitchBook, like IBISWorld, other sorts of third-party data platforms that will tell you, hey, great performance looks like this in terms of profit percentage or revenue per employee or other metrics. Second way I encourage clients to think about this is, hey, does your industry or trade group have a way in a process where they invite users to submit financials and anonymize the data? This is very common in certain financial groups. I've had clients in the past, as an example, in factory floor automation and systems integration that encourage their membership on an annual basis to submit financials. They anonymize the data, and then they produce a report showing what average performance is and best-in-class performance for their industry. So that's a second option for you. Is there an industry or trade group you're a part of that does that? Third option is public companies. You say, Micah, the public companies that do what I do, they are monsters. They have all these advantages over me. Yes, but they're a starting point for understanding this. Whether you are a marketing agency or a waste disposal company, there are publicly traded companies that are required to disclose their financials. You can go read them in their annual reports and quarterly filings. You can say, this is the profit percentage they're generating. And oftentimes they'll tell you how they're generating it because they're required to disclose a lot of stuff. And you can compare that against what you're doing. Last one would just be industry relationships. I'm always in favor of CEOs of companies that I work with going out to the market and developing relationships with other CEOs who are non-competitive. You say, how does that work? Maybe you run a trash collection business in Atlanta and you know CEOs of other trash and municipal collection businesses in the West. So you're never going to compete against each other. You're in different geographies, right? So maybe you're developing a relationship, you're sharing best practices, and that's an amazing way to do it. You say, Michael, what's the benefit of defining best-in-class performance, coming back to this slide and defining profit percentage? The primary benefit that we use with clients is when we set that vision of what great performance looks like, and we actually calculate what you are at today. And to be clear, there's a lot of clients who are playing accounting games, and the number that you show to the tax man is oftentimes very different than the number you get valued off of. That's another conversation called recasting. I've had conversations with clients, as a heads up, just within the last week, where we recasted their financials and we compared them and we created what's called a profit gap. That's the difference between best in class profit percentage and where you are today. and we figured out what was costing them. And I'll give you three examples. I have a client up in Ohio. They're doing 8.2 million in the top line. When we recasted them and we compared the difference between best in class profit percentage and where they are today, $733,000 they're missing out on in profits a year. 8.2 million in top line revenue, $733,000. Had another client I've recasted financials for in the last week, missing out on 10% of their annual sales in bottom line profitability. Another client I work with, 13 million on the top line. They're generating 17% profitability. Best in class is 25%. Almost $1 million of profitability that they're losing out on. And so again, the beauty of setting this standard and vision of best in class performance is that it helps us to have a North Star to compare our performance against, look at the diff and say, wow, I'm missing out on quite a bit. There's obviously a compelling reason here to change. And so I would encourage you to leverage these data sources as benchmarks, to define that benchmark, figure out where you are today. And again, where you are today, you shouldn't be comparing the bottom line number on your tax return to this. You should be comparing a different number called recasted EBITDA to that number. So if you're not familiar with that, reach out. We're happy to have a conversation with you on that. I want to go now to the third question in our 8 questions that we're going to talk about today. And that is, what is my business worth? Might be the most common question I get. What's the process I need to follow? What's my business worth? And so I just want to walk you through this real quickly. One, I would encourage you to research deal comps for your industry. These are sold businesses for your industry. Often the toughest one for a business owner to do on their own. You might hear ranges, you might hear stories, but many of them are years old and a lot of things change, particularly with interest rates and cost of capital and different things of that nature. But I'll give you a couple of different data sources that you could look to if you're willing to invest and to pay for these things. There are third-party databases like Deal Stats by VVR. There's IBIS World. There's PitchBook. There's even rules of thumb that are put out by my friend Ron West and his family for over 100 years in the Business Reference Guide out of North Carolina that everybody knows in the business brokerage community. And I think what you're going to find with all these different data sources is that you want to come up with a range. For your industry, what is the range that businesses are trading at? That's your first step, right? You want to research the deal comps. Hey, is it 3 to 8 times annual earnings? Is it 3 to 6? Is it 3 to 12 times or 3 to 9 times? As a second step, we're seeking to establish that range. And then as we understand the range, the logical question is, where is my business on the range? And what can I do to improve it where it's at in the range? So I'll give you a real world example. I have a client who's in the world of marketing and advertising. And in marketing and advertising, what you're going to find is that most businesses are going to trade anywhere from 3 times annual earnings up to maybe 12 times on the very high end. And so this client actually, we established that range of value through doing deal comp analysis, figured out that they're probably about 4 times annual earnings. They're pushing about 2 million to the bottom line right now. Got some work to do, some maturity to go through. And so what we figured out is that we set a goal for them that with some improvement over the next couple of years, they would trade at 6 times annual earnings and then move beyond that potentially to much more than 6 times annual earnings. What enabled us to do that? We researched the deal comps. We spread out a range of value, 3 to 12 times. We ran an assessment. We figured out where this client was at based both upon the size of the client as well as their maturity in certain areas of the business, and figured out they're probably worth about 4 times annual earnings, but then pinpointed opportunities to improve where they're at on that range of earnings. The beauty of this process is we can then move into a conversation around whether there is a value gap. So I want to talk about value gaps in 3 different ways. So a value gap is what your company is worth, or rather, what it's not worth, what you're missing out on. We talked about a profit gap a minute ago with benchmarking. Hey, best-in-class businesses are at 25% bottom line profitability, but maybe my business is at 17%. And so I take that 8% diff and I apply it across my revenue, and that's my profit gap. Very similar concept here with the value gap. So I want to talk about that in 2 different ways. The first thing is, if you've got a profit gap, you automatically have a value gap. So let's take that client that's generating $13 million in top line revenue, who has $1 million profit gap and trades at 4 times annual earnings. So they're missing out on $1 million a year now, present tense. But they're also missing out in their valuation of that $1 million times four, because they trade on 4 times annual earnings when it comes to their value. Now, where we're going over the next couple of years with that client is that that $1 million of profit would translate into a $6 million valuation gap. So the first moral of the story is if you've got a profit gap, you automatically have a value gap, right? You're missing out on value at time of exit. Second thing I would point out to you in this right-hand column that you see on screen is that value gaps can often be driven by immaturity, a lack of maturity, immaturity in the intangible assets of your business. You say, Micah, that's a lot of words. What do you mean by that? I would say there are certain things when you get into the game of growing value, you have to step back and answer the question, what grows profits and what grows value? And what you will rapidly find is that what grows profits and what grows value is not what shows up on the balance sheet of your company. It's a lot of the things that don't show up on the balance sheet of your company. They're intangibles. They're not tangible assets. You say, Michael, what are those? Customers, the capital you're building up with customers, with employees, and the culture and the way that you manage employees and how you get them to do their best work, the way that you do your strategy and planning and execution in your business. That's operational capital. Maybe fourthly, the way that you have built an amazing brand externally to your company and internally as culture. The thought process is this: as you grow in maturity in those 4 different areas, they're going to drive more profits to the bottom line and they're going to drive your valuation up on the top line. And so you can very easily have a value gap stemming from a profit gap or stemming from a lack of maturity in those intangibles in your business. And so one of the best things you want to do is begin to, again, assess. We talked about this in the very first step, assessing your attractiveness and readiness to sell. What we do is we're assessing those intangibles in that process. We're identifying ways to strategically improve them every 90 days, and that's going to lead to greater profits and greater value. Hey, fourth question we want to answer out of 8 as we seek to craft a successful exit, not just a successful exit, but a legendary exit, is coming to a very personal place, not a business place, but a personal place. And that is for you as an owner. How do you plan to live? What does a life of significance mean to you? And how do you plan to live it now and after the exit? So I want to launch into that just for a quick moment here. Hey, one of the things that we learn as we open the newspaper every day and we open our business journals in particular is that the world is trying to tell us what significance means. And when you open up your local business journal or you open up your social media profile, you get indoctrinated into it, right? The local business journal is going to tell you that business success means hiring more people, moving into a bigger building and building buildings, and ultimately adding more revenue. When you open up Instagram and you see a lot of the stories that are there, it's going to be, hey, look at these amazing vacations I went on with my kids, whether it's snowmobiling in Montana or skiing in Aspen or the view off the back porch of my second home or Ivy League schools for my kids. Those are the things that you are going to get indoctrinated into by default on social media and in the business journals. I'm not here to demonize these things, but I am here to say to you, these are not the things that I believe make for a life of significance, and that I think the tome of history tells us makes for a life of significance. You say, Michael, what does a life of significance look like? I think a life of significance is one that is lived by what people are going to say at our funeral. So I want to just dive into that for a quick moment. I've never heard anybody give a eulogy at a funeral about an amazing second home. Just never have. I've heard people talk about memories that were made of the second home, but I've never heard them talk about the house. And so I think it's really sort of 3 issues that people talk about in eulogies when we're gone. One, it's personal qualities. Hey, this was a kind person. They were a giving person. They were a committed person. They were somebody who believed in me, right? I think secondly, it's relational impact. It's how you made people feel through your presence and relationship with them and the memories that you created together. With your family, with your friends, even with employees and customers. It's the direct reports who spoke to your role in their life. It's the employee who found a fulfilling workplace at your company for the first time in their career. It's a struggling family that you were able to help in some sort of way. I think thirdly, we see in eulogies people who have made enduring changes to society. So it's through your life, through your service, through your work. Some folks just have an opportunity to actually make really enduring changes. And so I think the common thread that we see is that a life of significance is a life that is lived in light of our calling, of what we believe we're here to do on this earth, but also a life that's lived for the good of other people. So again, I'm not here to demonize having stuff. There's a lot of great things you can do with stuff and with money. Um, but living a life of significance is not about stuff. It's about making an impact in the lives of people. And so I just want to challenge you to think about, whether the life that you're living is really going to be a life that's going to deliver joy in meaning significance to you. And that's something that we work through with our clients. You say, Micah, how do I love this concept of a life of significance. I want to live my life with purpose. I want to live my life with intention. How do I do it? I'm just going to breeze through what is a very difficult topic in maybe 60 seconds here for you. First thing that we do with our clients is we encourage them to define their personal values, define, secondly, their purpose, why they believe they're here on this earth, and thirdly, to get really clear about their uniqueness. What are the gifts they've been given and the skills they've cultivated and the things they're passionate about in their life? I think the beauty of doing that, defining your personal values, purpose, uniqueness, is three different applications you can see on screen in action two. Application one is, as you do that, you get a shot as a business owner of decoupling your identity from just being a business owner. You've got a chance of stepping back and saying, am I living my life in alignment with the things that I believe today? What needs to change in the relationship between me and my business so that I can live out my values, purpose, and uniqueness? The second application is this. You get to envision and start dreaming about how you're going to put those values, purpose, and uniqueness that are unchangeable to work in a new calling after you sell your company. What are you going to do? How are you going to make sure that these things get put on display? What is the life that is going to continue to allow you to do that even though you're not owning a company, right? The third thing that you can do when you get really clear on this is you can start to produce a personal budget for what that life after exiting looks like and what it costs, right? Because everything has a number that's associated with it if we start to get clear on the life that we want to live. You can take that budget to your personal wealth advisor. You can develop a personal financial plan. And as we're going to talk about in just a moment, that ought to be defining the target valuation that you are building your company to for an exit. And so we're going to talk about that in just a moment. Third impact of living a life of significance or action I would encourage you on is this. This isn't the story that you're hearing everywhere. And so if you want to live a life of significance, you need to surround yourself with people who are committed to the same exact thing. And that's what we hear so frequently from purpose-driven entrepreneurs. They say, I want to live this kind of a life, but I'm just struggling to find folks who actually believe the same thing. And so if that's you, we'd love to welcome you into our own community and encourage you as you continue to move forward in living your own life of significance. All right, we're halfway through our 8 questions. We're making great time. Jen, I just want to pause real quick and ask, is there any questions in our Q&A that we ought to address now as opposed to holding them to the end?
No, I think we can hold them till the end.
Awesome. Awesome. Thank you very much. So we said there's 8 questions. We've addressed 4. We're about to dive into the 5th, and we're going to have a quick recap in a moment. So the 5th is target valuation. This is a question you need to ask yourself. What number is going to fund your unique personal financial goals? Everybody I have ever met is building a $100 million company. And it's a sign that ego drives our goals more than personalized planning. We were on a podcast and I interviewed a friend of mine, Dr. Eric Roman, who sold a business to private equity for 40, 50 million in 2019. And that was an insight that he had. He said, I was building towards a $100 million exit, but that was for my ego. I didn't need that much money to be able to move on and live the life that I wanted. And I want to challenge you on that topic. I think what we encourage our clients to do as an outflow of defining that life of significance. Again, what are my values? What's my purpose? What's my uniqueness? How do I want to live in alignment with that today? What am I going to do after I sell the company, right? Because we all need purpose and meaning in our life. What we encourage our clients to do is to craft that personal budget, take it to their wealth advisor, and ultimately define that target number that's going to fully fund their unique personal financial goals for the rest of their life. Because what I know from doing this for many years is that your number is different than anybody else's number that I've ever worked with. And so we encourage clients to define what we call a wealth gap. And a wealth gap is this. If I shut off all the cash that's coming out of your business today, And if I exclude the value of your company because you can't sell it, how much money are you short in order to be able to move on and live that life of significance that you want to live? How much do we need to fund that life for the rest of your life? Literally forever. Um, a couple of key points about this is that number needs to take into account taxation. Do you realize taxes are the single biggest expense in your exit? Yes, you're going to pay a lot of money to an M&A attorney, and you should because they'll make it back. Yes, you should get tax advisory. Yes, you should get advisory along the way. The biggest expense is taxation. And so when you're factoring in your exit, you got to factor in taxation. You got to factor in things like performance-based earnouts, equity rollovers at time of sale. Everybody overlooks these in their planning. And particularly if you are going to build a business to be worth more than $5 to $8 million, you're going to start approaching the $10 million in value. These things are huge. You're not going to get all that money up front when you build a really valuable business. You might have a 10, 25, 50 million, $100 million exit. Very rarely do you get 100% of that money up front in cash. And so we've got to figure that out. We've got to model that in your personal financial planning with your wealth advisors. I'd also say that your target number can also consider charitable goals. What are the causes that you are passionate about in this world? Ones that you don't have to wait on politicians to legislate and fund, but ones that you can make a difference in. Maybe that's part of the piece of that target valuation number. Hey, I want to allocate $1 million, $5 million, $10 million to causes that I am passionate about. That's something that we encourage our clients to consider. I think, but equally as important as defining the target valuation is defining what achieving that means for you and your family and what not achieving it means for you and your family. And the reason I say that is because of this. The hardest thing in all of business when you're transforming a company, when you're growing it from 10 million to 25 million in the valuation, or you're growing from 3 to 12 million, or you're going from 25 to 75 million in the valuation, the hardest thing is changing you. It's the change in the beliefs and it's the change in the action that growth requires from us as entrepreneurs as we're going to seek to grow and expand and do things we've never done before and empower others. That is the toughest piece about growing a business. And if you don't have a compelling enough reason about what all of this change is going to enable for you and your family, and conversely, what it's not going to enable, what I've typically found is that about 6 months into working with a client wants to start going back to their old ways. And so one of the things that we key in on with a client is not just, hey, what's the number that's going to fully fund you for the rest of your life, but why? What does it look like? Because this is going to be a tough journey oftentimes, and you need to have that really clear in your mind about exactly what this is going to enable for you. And conversely, what you're going to be missing out on if you don't achieve this. I want to move to our sixth question out of 8 that's going to help you get clarity on where you want to go. And that is this question here. Who do you want to sell to? How do you want to sell? There are 8 ways to exit a business. There's really only 8. It's very simple. And so what we seek to do with a client in the first 6 months that we work with them, first 3 months approximately for this question is to say, hey, which of these options are you interested in? And the first step is to start eliminating things out of the list. And so I'm just going to walk you through. We're going to go through this list here on the left of internal options. Literally have had clients, had a conversation this morning with a client about this. Had a conversation last week with a client about this. Had a conversation yesterday with a prospective client about this. Um, and so frequently what happens is, we'll look at the family transfer. I'll say, hey, do you have any relatives? You have children who want to come into the business and run the business and take it over from you? Well, if the answer is no, we can eliminate it right off the list, right? Hey, if it's a business that does not have a partner, it's owned by one person, well, we can take the third option on the left off the list, sale to existing partners. Then we start to ask the question, hey, is there anybody in your management or leadership team that might be interested in buying the business from you? And very frequently that question is answered affirmatively. And that's a really common option of the management buyout. The last one is an ESOP, and that's where you're literally going to sell the entire company to employees. And I will say there's a lot of desire and aspiration to do that right now in the marketplace, and we'll process that together in a minute on the pros and cons of it. Then we'll jump over to the right column and I'll say, hey, orderly liquidation is not what you want. That's shutting the doors and liquidating all your assets. It's the lowest price generally you can get for a company. We've got an initial public offering or IPO. Most privately held companies are not ready for that. We've got a recap, which is bringing in a growth partner, minority or majority, to fuel the next phase of growth. And then we've got a third party, sale to a third party, very frequently another owner operator, a private equity firm, or somebody in your industry who's a strategic acquirer who wants your customer list, your intellectual property, your product or service offering, or a variety of other things. I'll just share with you how this played out with a client that I had a conversation with recently. And actually, one of the things I'll say to you that you want to be thinking about with these various options is not just that the options exist, but if you're early on or you're thinking about exiting in the next 1 year, 3 years, 5 years, or even beyond, you want to start to understand the differences between these options in three areas. How do these options begin to think about how do these options differ and how they value your company? How do these options differ in the terms that they're going to put on you? Reps and warranties, earnouts. Thirdly, how do they differ in when you get paid, right? And so I'm just going to walk you through this real quickly. I had a client I've been working with. It's currently valued at just over $10 million. You can see this on screen here. And we put together three slides for them. One on a management buyout, one, if you look at the header here, on a ESOP, and one on a third-party sale. And so I'm just going to go backwards and you're going to see a couple of things. Again, potentially all these options would value the company the same. This is a 4x EBITDA valuation for a financial acquirer. Let's go down to the second row. One of the things that you got to understand is what are the transaction costs to do this deal. To sell to a leader in his company, this owner would pay probably about 100 grand in transaction costs. To do an ESOP, much more expensive, 630 grand. To sell to a third party like private equity, where there's a lot more rigorous due diligence and things that are going on, as much as $700,000, as well as fees to business broker, M&A advisor, investment banker to rep that deal, right? What are the other differences as we go back? Management buyout, we figured out that, his leader was going to be limited to financing probably about 3 times annual earnings at one time for the company. And so really it was probably 50 to 70% maximum that could be purchased up front without severely handicapping the cash flow of the company. We looked at the impact of taxation at the bottom, right? Whereas when we go to an ESOP, we found an ESOP is even less. Most of the time in an ESOP, you're limited to financing 2 to 3 times annual earnings right now with the really high cost of interest rates. And so we figured out for this particular owner that an ESOP really was not the best choice for him if he wanted to get paid rather quickly. We felt that that was going to take a long time. And then a third party sale, potentially could be up to a 100% sale up front. But we felt that there was going to be some performance-based earnouts and certainly an equity rollover into the private equity fund. And so even if you're not tracking with me on all the terminology, I use these three slides just to say this. The path that you choose to, one, you got to start by building with the end in mind, right? This is a great principle from our friend Stephen Covey and 7 Habits of Highly Effective People. Start with the end in mind. And one of the things you want to do when you think about who you want to sell to and how you want to sell is you want to understand the difference between pricing, terms, that was very different here between these three options, and when you get paid, the cash payments, right? So now let's go to this last question of timeline to sell. Hey, what's your ideal timeline? Ideal timelines are driven by a lot of different things, but I'll put three up on screen that I hear very frequently from owners. The first thing I would just encourage you is have a timeline. Don't make it open-ended. Hey, I'm building to get where I want to go within 3 years, 5 years, 7 years, 10 years. But common things I hear from folks are, hey, I've had health concerns and I want to make sure that I'm ready to go. I want to get out of this business within a certain time period because I want to make sure I get time to do certain other things in my life. I've heard from different clients within the last year, hey, I got a spouse retiring. One client said, hey, I got a spouse who's a teacher and she's retiring in 3 years. And so my deadline is 3 years because we want to retire from where we are today and we want to move geographically to a different location. So it could be a spouse, could be kids graduating high school, graduating college. Hey, I want to move to be close to my children wherever they're at in the season of life. This is going to be different for every client. And what I would encourage you to do is just to find that timeline and know why that is your timeline. I'm going to do a quick recap. I'm going to go into our last bullet point here and then head into the close and open up for some Q&A. But one, what have we learned so far? We talked about 8 questions that you need to have answers to in order to achieve not just a successful exit, but a truly legendary exit. One that your kids, your grandkids, and you will be talking about long after this because it's more than the exit. It's more than just the numbers, right? And so in this first column, where am I at today? A couple of quick thoughts there. Um, these three questions, when we're working with a client, we answer them in the first 6 weeks of an engagement. This middle column here, so and again, those questions are, am I ready to sell? Am I attractive and ready? I get curb appeal, I can pass the home inspection in an equivalent parlance to buying a home. Hey, I know what best in class performance is. I know where I'm at relative to it. I know what it's costing me not to be best in class. Hey, I know what I'm worth today and I know where I could be worth, right? And that's a third piece of the puzzle. And again, these are three questions that we typically answer with clients in an opening 6 week engagement, called an exit clarity engagement. This middle column here are four questions that we typically take about another 2 months to answer. Hey, how do I live a life of significance? What does that mean to me? Am I living in alignment with it today? What does it look like for the future so I can start testing it and so I can start developing a personal budget to hand to my wealth advisor? Uh, in concert with your wealth advisor, what is the number that's going to fully fund that budget for the rest of your life? What's your timeline and which of those exit options is interesting to you? So we covered 7 of the 8 questions so far. When you're clear on where you are, when you're clear on where you go, where you want to go, now you can answer the critical last question. How do I bridge the gap between those two places? Because most people, when they define where they are today in their business, and they define where they want to go, they're not there yet, right? There's still work to be done. And so I just want to address in the last couple of slides how we bridge the gap and how I want to encourage you to bridge the gap in your own business and actually get where you want to go, not burn a bunch of time, but truly get there. Okay, first step in bridging the gap is to produce a financial model. For non-finance people in the room, don't glaze over. I'm going to make this super simple for you. Because as you put this on one sheet of paper, this is going to be very, very clarifying for you. And it's going to be very apparent what you need to do to achieve your target valuation. So I want to walk you through this in just a minute or less. First thing I want you to pay attention to on screen is look at the very bottom row called valuation. This is a real client, by the way, that I work with and had an opportunity to start working with last year. When we engaged, they actually had done a formal valuation with a third party, and they were valued at $10,081,000, or about 4 times annual earnings, to give you perspective. We have set a goal over here on the right for a variety of reasons. Because we worked through the first 7 questions, we set a goal of growing the company to a $25 million valuation to make this owner financially independent for the rest of his life and to help him live the life of significance that he wants to live, right? So what we start to do to get from 10 to 25 million is there's really only 3 variables. This is a very simple financial model. Year-over-year revenue growth, EBITDA percentage, that's earnings before interest, taxes, depreciation, amortization. That's a specific way of looking at profit percentage. So we could say profit percentage, though it's a little bit different. That's a second driver. What percentage of revenue are our profits? Third is what multiple of those annual profits are we trading off of? And what I like to do with a client, what I would encourage you to do is create your own custom recipe, right? Play with the numbers. How does revenue growth impact getting to the 25 million? How does growing your EBITDA percentage, which we have here in this model, impact that? How does doing work to move up that trading range of multiples and go from 4.5 times to 6 times, like this client is doing, how does that impact getting to 25 million, right? And so you can see in this particular scenario, we had a flat first year of growth because we're in some transformation stuff and we're growing at a very light 10% a year on the top line. But what you will see is that we're forecasting that EBITDA percentage is going to go from 17% this year all the way up to 25% 5 years from now. And we have the plays in the playbook to do it. Pricing increases, increasing our utilization rate from 51 to 60% alone will do that for this particular client. And then we've got different intangibles we're strengthening here. Again, even if you don't follow me on all the finance lingo, the big takeaway here is this. You've got to chart out how to go from your current valuation, 10 million for this client, to the target valuation of 25 million. If it's complicated, you won't understand it and your team won't understand it. If you put it on one sheet of paper, everybody can understand it, right? That's step one. Step two is this. You got to define what needs to change in your business to achieve the numbers you put on a spreadsheet. Because as I like to say to folks all the time, I could put numbers in spreadsheets all day long, but it doesn't mean that that's bringing it into reality in the business. Very rarely are you going to transform a company's performance by focusing on accounting and finance. You're going to do it by focusing on the things that we have on screen. So the first step, or the next step rather, and I've got 4 steps here total to be clear on how to bridge the gap. So first step is creating a financial model. Second step is addressing the full breadth of strategy. Strategy is what we should do and why should we do it. And we like to address it in 3 areas: the go-to-market strategy, what needs to change in your product and service offering, your pricing, your marketing, your sales. We like to look at the operational plan. Do we have the right people? Do we have the right processes and systems of execution? And then thirdly, we like to look at the financial plan. Do we have a budget in place that shows what this looks like? How much working capital do we need in growth capital, right? This is what is a complete plan in breadth, right? I'm going to go now to a third element of strategy, and that is the depth of the strategy. One of the big mistakes I see owners and leadership teams make very commonly is certainly breadth issues and not dealing with go-to-market and operational financial planning. But they'll set a goal, right? So they got a target, but they don't have the right depth of planning. And for us, we focus on depth in 4 areas with clients. One, do we have the right person inside of the business owning this area? That's the number one issue in all of business. Right person in the right seat, as Jim Collins has told us. Second, are we picking the right things to work on? If I come in and audit your business, there'll probably be 47 things we could find out that we could be doing better, but that's not helpful to you because you don't have the time, the energy, the resources to do all 47 things. You need to know what's the top one, maybe 2 things to do right now because it's going to have a domino effect in your business. And so that's what we encourage clients to focus on and think about. If you've never sold a company before, never gone through the scale of the phase of scaling that you're currently in, that's probably going to be tough for you to see that on your own. And that's obviously where outside partners can be a great help. Planning, how do we go once we've set the goal and we figured out what we should do and why we should do it? How do we bridge the gap between here and there, right? Multiple paths to that destination. Last thing we'd like to audit on depth is, have we properly resourced these plans with the right level of people and process and technology? And I'll tell you as a freebie, the number one issue with SMART goals that I have seen in business for the last 10 years is that they're unattainable because companies have not followed the process you see on screen and gotten all the way down to the level of resourcing and actually figure that out. Because generally what happens is that we find out we don't have enough resources to achieve the goals that we have. And then we have to swing back and forth between the goal setting and efficiency and the resourcing level. Last thing I'll just share with you, and then we'll move into our close and open up for Q&A, is that there are 4 intangibles, we've talked about them earlier, that tend to drive profits and value in the business. And we see these on the screen. And so we'd like to do an audit on this level as well. And so as you think about these 4 steps, and again, I'm going to go back in bridging the gap, we create a financial model on one sheet of paper to go from here to there. But as you think about breadth of strategy and depth of strategy and these 4 value drivers, I like to think about these the way I like to learn to write a paper, a research paper in college. And that is, there's a rough draft, right? I might start here with the breadth of strategy. Hey, what am I missing? What should I be working on? I like to step away and then I'll come back and I'll think about the depth. Hey, are we deep enough in how we're approaching each one of these elements of our strategy? What are we missing? And then I like to come back and do another pass and I like to say, are we missing areas in the intangible capitals? Because that's really what drives business. The last thing I would share with you just before we get to the close and open it up for Q&A is this piece here. I have a principle I live by in my life, both personally and professionally, and this is at the heart of how we work with clients at Legendary Access, and that is, you need 2 things in order to look back 90 days from now. If you want to get to 3 years from now, or 3 months from now, or 3 days from now, and be content with the progress you've made, what we call purposeful action, you need 2 things. You need clarity and you need action. And what you might have gotten through this webinar today is some clarity. You might have gotten insights about 8 questions you needed to answer. But at the end of the day, you can gain all the knowledge in the world, but all the knowledge in the world is not going to change your situation. You have to couple knowledge and clarity with action. And that's the loop that we take with our clients. Let's drive to clarity, let's take action. Let's drive to clarity, let's take action. When you begin to do that in these 8 areas, you will make forward progress. Hey, great to be with everybody. Up on screen, you're going to see two different things, two QR codes. I'm going to ask Jenna to open up the Q&A in just a moment. On the left, you're going to see another QR code, and Jenna's actually going to drop in the chat even the URL. So if you can't access the QR code, she's going to have a URL in the chat where you could go take that assessment. If you're an advisor, it might be great for you to go through that assessment to know what's available for your client as well. And then on the right-hand side, if this has resonated with you and you say, I want to take action, right? I want to get some more custom tailored advice. We do give away typically once a month a free strategy session. That's going to close tomorrow at 5 o'clock. Scan that QR code, apply for that. Jen is also going to put a link for that in the chat. With that, I'm going to open it up. Jenna, what questions do we have? Do we have questions in the chat? And then if you want to ask a question live, just go ahead and click the raise my hand feature. And we'll just hang here and answer questions for as long as we need to. So Jenna, what questions do we have?
Yeah, so let's start with Matt asked, what's the biggest issue you see in bridging the gap?
Hmm. I think the biggest issue in bridging the gap, again, if you know where you are and you know where you want to go, is hmm, companies are thinking in incremental performance. They're thinking, well, I did this last year, and so maybe next year I can do 10% more, 20% more. That's the wrong way to think about it. What you need to do is you need to reverse engineer what it's going to take to get to that target valuation and enter into a how might we frame of mind. You might need to start growing at a more rapid pace than you ever have before in the past. You might need to start producing a higher profit percentage than you ever have before in the past, but it doesn't mean it's not possible. So I would start with the end in mind. I will reverse engineer. That's how I would answer that, Matt. Great question. What else, Jenna?
Awesome. And then Martin said he is not planning for an exit for maybe 10 plus years. Where would you recommend that he focus his time?
Hmm, that's a great question. Yeah, some of our clients that we work with are very focused on the idea of exiting, but very commonly we work with clients in their 30s and their 40s, early 50s, and they say that same exact thing. Like, I'm not going to sell for 10 plus years. Does this even make sense for me? And I would say 100%, because the point of getting clear in the future is so that all the actions that you and your business are taking today are actually going to get you there. And the beauty of best in class is that as you build a business to be best in class, what does it do for you? It creates more profitability. You can pay yourself more money. You can hire the right folks in your business. You can have time for those passions and hobbies outside of your business. You can make a greater impact in the world. And so if you focus on just simply transforming your company to be best in class, um, even though you don't want to sell for 10 plus years, that is going to open up so many opportunities for you to live the life that you want to live and to impact more people. And that's how I would answer your question. Great one. Anything else, Jenna?
Awesome. We've got one more from Emily. Where would you start in capturing a profit gap?
Yeah, really great question. So again, a profit gap is, as an example, that client, we define 25% is best in class for marketing advertising agencies, but they're at 17%. And so that 8% diff is costing them $1 million on 13 million of revenue. Yeah, where would I start? Gross margin. That's always the number one place to start in business. Quick refresher. Gross margin is revenue minus cost of goods sold. Cost of goods sold is what it takes to make our widget if we make widgets. And if we're a services business, it's if I'm a lawn care business and I'm out fertilizing lawns, the labor of my employees to go out there and spray the chemicals along with the chemicals, those are my cost of goods sold. So I always start with cost of goods sold, and there's three plays. So I'm pulling back the playbook. You can deploy these right away. Play one, increase pricing. Did you know that the average small business has not increased pricing in 7 years? That's astounding. Inflation has definitely happened in 7 years. So I'm always looking for opportunities to increase pricing while maintaining customer base. Second issue, how do we renegotiate supplier input? So if I make a process, how do I renegotiate raw materials costs? If I spray those chemicals in the lawn, how do I buy them at a lower price? Third thing, and I'll leave you with this on gross margin. How do I increase every business has a system of production. It doesn't matter if you have a manufacturing line or you got a truck with two guys that goes out and sprays chemicals on lawns, right? That truck with a guy or two guys can do so much revenue per day. And so as you start to set a benchmark of how much revenue that a manufacturing line or the lawn care company can do with one truck in a day, then you start to compare that to where you're at today. And the utilization percentage, an increasing utilization percentage is always a huge play for companies to increase their gross margin because most of the time you're paying that same lease payment on the vehicle. You're paying that employee for 8 hours a day, but if we can get a few more lawns a day on the fertilization, out of that, then we're generating more revenue, and that's going to increase gross margin. So that's how I would answer that question. And again, that's applicable to any industry. Great stuff. Anything else, Jenna?
No, that is all of our Q&A questions.
Wonderful. Well, hey, everybody, thanks for hanging with us here through the end. It's great to be with you. Complete that free assessment. It's going to take you probably 3-5 minutes tops. If you want to apply for a free strategy session, we'll be closing that and selecting somebody by end of day tomorrow. But great to be with you. I wish you a great evening with your family and hope to connect with you soon. And with that, we will wrap up.